Great, thank you. My name is John Beccia. I'm the co-founder and CEO of a regulatory advisory firm called the FS Vector. We work with banks and fintechs and everything in between around regulatory issues and helping think through policy issues as well on the lobbying side. Today we're going to talk a little bit about third-party risk management, and I know we've talked a lot today about the bank partnership model and banking as a service. Hopefully going to provide a little more guidance, talk a little bit about what's happening from a regulatory and supervisory perspective, maybe do a little bit of different spin and talk about the practical implications, especially for some folks who are seeing this day in and day out at their institution or on the advisory side. And then talk more importantly about what is needed. And we talk, the title of the panel is clarity is critical, like everything else. The uncertainty makes it difficult for innovation to happen. Before we do that, I'm just going to ask our panel to quickly introduce themselves, and then we'll get into it. Janet?
Thanks, John. Janet Hale, a Senior Managing Director with FTI Consulting. I've been with FTI for about 2 years now, formerly with another consulting firm. Industry background, I led the consumer compliance area for Key Bank in Cleveland, Ohio, and I actually started my career with the OCC.
Hi, I'm Arlen Gelbard. I'm the General Counsel of Cross River Bank. I've been there now for 7 years. Prior to that, spent a short period of time working actually with Janet at a consulting firm, and I've held different general counsel and bank president positions over the course of the past 20 years.
Hi, I'm Rob Lavet. I'm General Counsel at SoFi. I've been with SoFi really from almost the beginning of the company in 2012. And we've transitioned from a fintech to a national bank and a bank holding company. Before SoFi, I was the general counsel of Sallie Mae and worked at the Justice Department early in my career and at a couple of law firms.
Hi, everybody. I'm Chris Peterson. I'm a law professor at the University of Utah in Salt Lake City, and I'm also of counsel at a law firm, 2 jobs, of counsel at a law firm here in Washington, D.C. called Gupta Wessler. We're in a public interest appellate law firm. I used to work at the CFPB for about 4 years and also at the Pentagon for a little while on the Military Lending Act, and have written about consumer financial services issues for most of my career.
Great. Well, again, we talked about banking as a service, and I think, it's either interesting times. I think what gets lost in a lot of the conversation is when we talk about regulation is the actual benefits and the good things that could come out of these relationships, and especially with some of the innovation that is happening that can provide better services to consumers and businesses. But it's a challenging environment, and if you're on both sides of the equation, if you're a fintech, you're trying to get to market often, and it's difficult if you do it on your own. It's hard to find a bank partner, one, especially in a post-SVB world, but two, you don't really want to go down the road of getting all these licenses or getting a de novo charter or something like that is very difficult. So you have the opportunity to work with banks and get those types of products and services. And from a bank perspective, it's a way to innovate. It's a way to get additional revenue in a very challenging environment. But we have this whole regulatory overhang now, and so the question is, how do you structure these relationships? And there's many different ways that these partnerships happen. And from a practical standpoint, you have some aspects. You have the bank doing more, and some structures you have on the other end of the spectrum. Fintechs are relied on to do more of the compliance work. And then there's the in-between. There's the use of middleware providers and other technology to help kind of bridge the gap here. And each one of those has been looked at with different types of skepticism from a regulatory perspective. We know that we have a very heavily tough regulatory environment in general, a lot of regulation by enforcement, a lot of more questions and answers. The regulators have for a while now, had offices of innovation. Some of those have been reconfigured recently, like OCC and others. We know the Federal Reserve is looking at creating specialty oversight around novel activities. But what does this mean, from a day-to-day perspective? And what does it mean for third-party risk management? So let's get into that specifically in terms of the guidance. We have seen some guidance in this space. Some have said it doesn't provide a lot of additional context, but at least, we're starting to see a little bit more of the roadmap. So maybe Janet, we'll start with you and talk a little about the guidance we have to date, and then from an examination supervisory standpoint, how is that kind of played out and provided? What are the expectations that we're seeing from regulators?
Yeah, who would have thought third-party risk management is the hot topic of the conversation today? I mean, I would have assumed it's AI or something with a little bit more interest. But third-party risk management has been around forever. I mean, when I was at KeyBank, 10, 15 years ago, third-party risk management was a part of our GRC program, and we reported on it up to the board. Honestly, when it first came out, and for those of you, I'm sure you are all familiar with it, but for those of you that are not, the final guidance came out this past June. Having read the guidance, I thought, okay, what's the big deal here, frankly? Like to your point, that was my view. And so I think it's because I had to go back and look at the prior guidance. So in an advisory role, we never necessarily advise to the guidance itself. We would generally advise to what's the industry best practice, right? So when I looked at the prior guidance, I was always thinking, okay, what more should the bank be doing? How do you interpret what that guidance is? And I think with the newer guidance, some of that is now baked into it. And so what are some of the key takeaways from that guidance? I would say that ongoing monitoring is not once a year, right? Like it used to be 15 years ago, right? Ongoing monitoring is truly ongoing. And I heard a couple of comments this morning in which some of the presenters stated, like, treat your fintech like a branch. Well, it has gone that far. So truly, and I know the gentleman here could speak to that as well, we really need to bring in our fintech partners and have a true partnership, relationship, trusted, where we can do the ongoing monitoring, look at the data, and of course data is key, right? It has to be accurate, and you have to be able to bring in all that data on a regular basis, and again, have that trusted relationship. So when you go back and you look at the new guidance, I think that's probably one of the biggest takeaways, is that ongoing monitoring. And I would say, for those of you who have read it, like I have, go to the very end of the guidance and look at the area that talks about supervisory review. And I think you'll see what the examiner's expectations are and what they're going to do when they walk in the door. And also there's a sentence in there that talks about how the regulators have the ability to directly review your third parties. And I think the language is when it permits, or there's some very specific, I think it's when the criteria warrants, something like that, right? And so be mindful of that as well.
Yeah, definitely agree. I think a key couple takeaways for me is that, it's clear the regulators more and more want to know this delegation of roles and responsibilities in terms of who's doing what. Obviously, the bank is ultimately responsible. Also, it seems what we're seeing in terms of the examinations is the examiners are drilling down more and more to the fintech clients in terms and more expectations around that type of monitoring and things like that. And so there's definitely a need to shore up the program based on that guidance. It is nothing new, but it's a matter of having it documented and actually implementing it in the best course. With that said, Chris, you spent some time at the CFPB, and we've seen the CFPB take on some additional supervisory authority for non-banks. But not only the CFPB, but the federal banking regulators and others. What are the posture of these agencies vis-a-vis the partnership model and third-party risk management? What are you seeing, and what do you think are the expectations there?
Well, I'm a professor, so I can't talk without saying something nerdy. But the dynamic between having a third party and a principal, it reminds me of this paper. It's kind of a famous paper by Professors Jensen and Meckling. It's like a 1970s paper, economists. Not Taylor Swift famous, obviously, but prominent. It's a prominent paper, and they're trying to come up with a theory for why it is that some companies form firms and then other things go outside of the firm. How do you organize economic activity within an institution versus outside of it? And They said one of the principal reasons is because of agency costs, and they defined that as the monitoring. The monitoring of the principal has to monitor the agent to make sure the agent's doing what they're supposed to. The bonding costs of the agent to make sure that they're, purchasing enough insurance or being willing to subrogate or whatnot to try to reimburse the principal if the agent harms the principal in some way. And then there's a sunk cost where sometimes the agent, the principal just can't get the agent to do what they want. In my own mind, I think of the lawyer that just daydreams when they're on the billable hour. I mean, how are you going to stop the lawyer from just racking up a billable hour while they're playing a video game on your phone, right? It can happen, and how are you going to stop them from doing it? Those things collectively create the agency cost, and you want to economically, you want to outsource something to an agent when the expected utility of the collaboration exceeds those three costs. And you can, but to exceed that, to have it make more sense to do it outside of the company, there's got to be something really special about that agent. They've got some specialization where they're sunk startup costs, and if they have multiple firms, they get economies of scale, and so they can use that specialization over and over again. And that's great, like we want that. But the problem that I see in the market is that a lot of the agency relationships that creep up is because actually there's something that agent can do with immunity, or maybe some action they can take with impunity that's objectionable. They're externalizing some negative externality onto consumers in some way that's problematic, and they can get away with it, at least in the short term. And a lot of the CFPBs work for a long time, including their third-party risk management guidelines, both in 2012 and revised in 2016, and really pretty similar to what we saw just recently, I think are really targeted toward trying to control that type of behavior. And some of the biggest cases at the CFPB have always been about that. The very first major case against Capital One was using a third-party call center to push sketchy add-on products in deceptive ways, $140 million case. And of course, the largest CFPB case was a JP Morgan Chase case where they were selling bad debts with inadequate documentation, many of which were time barred, and letting third-party debt collectors collect them. It was a multi-billion-dollar case, $4 billion, something like that. So, I mean, third-party management is at the heart of whether or not, many of the most important cases in the history of the CFPB, and I don't think that this really changes that much. It's just being a little bit more specific about the details. And it could be the case that a bank might get away with it for a while, but sooner or later, if they invest more capital in trying to circumvent a consumer protection rule, I think that the cops are going to catch up with them. I talk too much. I'll stop.
No, it's great. Arlen, so I mentioned earlier that regulation by enforcement, and we have seen some enforcement actions vis-a-vis partnerships. There has been some. We always look at enforcement actions as a roadmap of things to do or not to do. But from your perspective, I mean, Cross River is one of the leaders in this space. What are some of the lessons learned from some of these enforcement actions, and some tips that you can put into place in terms of how do you approach this, and what are again, back to the regulatory expectations here, which are somewhat still a work in progress.
Sure. I mean, obviously, for those of you who know Cross River know that we have a consent order in place that came in March in the area of fair lending. And I think that you can kind of think about that as almost a bit of a blueprint of what the expectations are, certainly the expectations of the FDIC, because that's our primary regulator. We talk about third-party, oversight, using the word oversight, and I think that it was said already that our regulators look at the lending that we do, for example, and just say, they're your loans, you're responsible, period, full stop. And how you divide up the responsibility between you and your third party, that's up to you, however you want to do it. But at the end of the day, you better make sure you can show that it's being done. And in looking at things like the consent order, what they're showing, or what they're expecting, is that we, first and foremost, as Janet mentioned, you've got to be sure you're getting the data. You got to be sure you're getting the data, you got to be sure you're getting the files, you got to be sure that you're able to produce it when requested. And regardless of whether or not the fintech themselves is the one who is doing the analytical work, you're responsible for fair lending. Now, in our consent order, thankfully, it was not based on any violations and not found any restitution. So you can think about it more programmatically. And from that perspective, I think everybody should look at that and say, this is the expectation. Even if it's not what you expected before, wake up. And it's not only for the banks that have to be sure that they're the ones responsible that it gets done, but also for the fintech partners. And there are a number of our fintech partner clients who are in this room, including Renaud, who just stepped off, who talked about the roles of each parts of the process of a loan origination, for example. But what's important is that the fintech partners have to understand that they have to do their part. They can't just say, oh, that's fair lending, that's the bank's problem. I mean, they have to be sure that they're collecting everything that they're required to and doing the analysis they're required to do it. And if not, they can be on the receiving end of a consent order or other enforcement. In this case, there was no one to go after because there was nothing that any particular partner did that was wrong. But they can do it. And in the FDIC world, they look at all of our partners as institution-affiliated parties. And if the FDIC asks us for something and we can't give it to them, the FDIC routinely says, would you like us to ask them directly? Usually that's enough of a reason for us to call our partner and say, come on, we got to get the information. So at the bottom line, you just got to think about the fact that it's your loan, make sure it's done right.
So Rob, you went through the process of actually buying a bank, which is interesting, especially given the current environment. Maybe you can quickly talk about lessons learned from that, and now that you're kind of in the regulatory tent, what are some of the best practices, or how do you approach third-party risk management?
Yeah. So we wanted to pursue a national bank charter. Really, we became a national bank last year. Our bank is about $25 billion in assets now. We pursued that charter really for a couple key reasons. One was to have a more durable and stable franchise. We're primarily a consumer lender. We're originating billions of dollars of consumer loans. And there are two principal advantages of that national bank charter. One was the ability to lower our cost of funds significantly, because we were primarily dependent on warehouse financing prior to acquiring the charter. As an aside, we had looked in the early days of SoFi at becoming an industrial loan corporation, and I had helped form Sallie Mae's Industrial Loan Corporation when I was there, but that avenue really was very difficult and kind of closed off even though the moratorium had ended. So besides the durability and the lowering your funding costs, the other principal advantage was we were a 50-state lender, and now we have that exportation power under Section 85 of the National Banking Act. And so you can export, and you have one, you don't have to deal with the state licenses, state exams. Now, what you trade that for is really rigorous, regulation at the federal level. I joke that we have the trifecta because, we have the OCC for our national bank, the Fed for our bank holding company, and because we've, grown over 10 billion, we'll have the CFPB as well. And, we were actually somewhat regulated as a fintech prior to becoming a bank because we were in the student lending business. And so under Title 10 of Dodd-Frank, the CFPB had supervisory authority over that student lending business. So I'd say the transition to becoming a national bank, has worked out well. I mean, it requires, and I'm fortunate, we've got some great people. I've hired in the audience Adam Cohen, Farah, Zubair, who have a great banking background, and so we've really focused on building our regulatory relations group within SoFi to deal with processes for exams. And it seems like when one exam's done, the next regulator's in, so it's almost perpetual. But when I think about third-party risk management, if you read the joint guidance, it's much broader than just banking as a service. It's your vendor relationships, even your inter-affiliate relationships. And we are not in the BaaS business or banking as a service business currently, but we are launching a program with a fintech that would be considered BaaS. But we've spent a lot of time with the regulators, so there's no surprises. Really kept them advised of every aspect of that. And I'd say the other big, change from kind of our fintech roots, and I think the last speaker alluded to this, quite well. But we've now got really well-defined processes for third-party risk management, and we have a new products committee which is very cross-functional, and I have I have legal, but compliance and AML also roll up to me, and so we have the ability to stop something if there's a problem. So it's fully vetted within the company, and then we'll go to the regulator, and make sure they understand exactly what we're doing. The product will be launched in a tempered way to make sure. Now, we have done, and I'd say, and this is common from what some of the other panelists have said and what Arlen said, we've done some third-party partnerships because we have a lot of applicants for our loans who, we can't underwrite, but we're looking for a way to service them through partnerships. You could call it decline monetization. And what I've seen lately is, with the focus on fair lending, I think the business sometimes has challenges like, why is it taking so long? Why can't we do this? But you really have to, because as Arlen said, you are viewed as the lender. And so fair lending is a priority right now. And you really have to go through all the traps and understand what the partner's program is. Have they done testing? Have they done disparate treatment testing, disparate impact testing? And I think if you look at the guidance, really, what I take from it is you really need to know your partner. And that means really checking what's their history of litigation, regulatory enforcement, how do they approach compliance? We have kind of a unique business model because we have some business-to-business companies, Galileo Financial Services, which is in some cases a program manager to fintechs, but also there's a sponsor bank, in the relationship. And at some point in the future, maybe SoFi would become a sponsor bank, but that program manager can actually help the fintech in the compliance area as well. So I probably have talked too long.
That's okay. No, that's great. That's helpful. And Janet, any other kind of best practices, tips, either for fintechs or banks as they think through how to navigate this environment?
Well, I'm going to go ahead and continue with that fair lending aspect because it's so important right now with the current administration. And so, as we all know, AI, modeling, bias, it's in the news every single day, right? And so that is definitely an area where I think the banks and the fintechs truly need to concentrate on. It's not a recent consent order, but I would highly recommend looking back at the Facebook consent order. You can learn a lot from it. Go back, look at not only the models that you're using at your financial institution, but the models that that are employed at the fintechs, right? And think about not only third-party risk management, but fourth-party risk management. So which marketing firms are you using? How are you using them? How is your fintech partner using them? And is that activity being monitored? Because do you truly know when you are reaching out to potential customers, what is in the model and how are they targeting those potential customers, especially in regards to digital? Digital redlining happens, we've seen it. Of course, we've gone in and tried to help put controls around that and mitigate that risk. But if you don't look, you're not going to find it. And if you don't find it, your regulators will. And that was very, very evident in Facebook. So I would highly recommend reviewing that consent order. But I do think that, again, and I guess I had to bring in AI to it after all, right? But I would definitely look at that consent order. I think there's a lot of lessons learned.
Okay. So we said clarity is needed here. So what are some of the solutions? How do we move forward and help innovation progress? Arlen, what ideas do you have here?
Well, one thing that I would suggest is something we did early on. I mean, third-party risk is the core of our business. So we've been focused on it for many years, whether it was Phil 44, which was really not much in terms of guidance, we made sure that our firm was effectively following the OCC guidance anyway, which effectively is what the new guidance is doing anyway. But one thing in the lending sphere that I would recommend people take a look at is guidance actually that was proposed and never adopted, which was Phil 50 of 2016, which was third-party risk management in the lending arena. And that guidance, which we internally adopted to follow, really has a lot of strong suggestions and areas that you really should focus on. And it was strong enough that when the group of banks, when WebBank and we and a couple of fintechs settled the Colorado litigation a few years ago, that was the core of that settlement. Was as long as the banks and the fintechs followed the rules and the prescriptions in that Phil 50, that would be strong enough to allow the partnership to continue. So that would be one thing that I would suggest, because it makes it easier. Otherwise, the guidance, even the latest guidance, clearly says that it's risk-based and it's based upon the perception of risk, and your perception of risk may be different than your regulators. But if you're looking to get specific guideposts, look to the consent orders and look to that proposed guidance. I think you'll find it very helpful.
Chris, go ahead, Rob.
I was just going to follow up on that and say, I think unfortunately, maybe I'm jaded, but guidance is going to come for the near future from supervisory activity as opposed to regulation. So I think you have to study all these consent orders and try to glean from it, where the parameters lie. And I think also it depends on who your regulator is, because they differ. So you really have to, look at it in a multidisciplinary way.
Yeah, I think it's also important, especially when there's always uncertainty, it's important to have a good relationship with your regulator and be proactive and communicating probably more than you normally would. I think that's always a best practice, right? Chris, what else in terms of other areas where we can eliminate some uncertainty or some action that could be taken in this space?
Well, for me, the bottom line is that if the third-party relationship is about taking advantage of some special new technology or specialization or greater capability in terms of the partner, that makes a lot of sense. But if what it's really about is circumventing or immunizing somebody from liability under a consumer protection statute, it might work short term, but it's going to be politically unpopular, and there'll be people who are trying to undo that puzzle to create liability for violating those underlying consumer protection laws. And like them or not like them, they tend to be pretty popular laws. So I think it's when you're circumventing consumer protection law that you're really taking on the most risk.
So Arlen, if you have a community banker comes up to you and says, should we get into this business? And where is the future of the business going? What advice or what thoughts would you give?
I say hire John.
Yeah, there you go.
No, wait a
Thank you.
And Janet. Sorry.
We can definitely partner on it.
Using both of them, I could say they're both excellent.
Yeah.
But seriously, I do think that it's important that if you don't know anything about the business or you're just starting in the business, I think it really is important to hire a really good consultant or more than one consultant, because they've seen the landscape. There's not going to be any single person who can have a really good view of a landscape, and going to a strong consulting firm, I think, can really help you set up the program. And your CEO may say, or your investors may say, I don't want to spend the money because they're expensive, and they're not cheap. I will say it's well worth the money in the long run, because you'll pay the price if you don't set it up the right way, and you're better off getting people who have the knowledge and the experience to help you set it up. That'd be my advice.
We have a couple minutes left. I just want to see if there's any questions in the audience. Chris, are there any other underlying policy issues here that are putting more pressure? I mean, we talk about specific third-party risk management guidance, but I know there's a lot of other regulatory proposals around activities that impact this model. Is there anything else that you're seeing that?
Well, I mean, I guess the other one I'll mention, this relates to what I said already, but look, the higher the interest rate in one of these partnerships, the more scrutiny it's going to get. And I get that You know, the National Bank Act provides preemption. The DIMCA provides a comparable form of preemption. But in the history of the American Republic, anytime a usury limit has been put on a ballot measure for the public to vote for, it always has passed, even when the industry that was opposing that usury measure outspent the consumer protection usury law advocates 30-1. It still passes. And so the overwhelming sentiment of the American public in both the Democratic and the Republican Party voters is to have some form of a traditional speed limit on the acceleration of prices or acceleration of interest in a loan. And you know, the way that the banking laws have been set up ever since 1978 and 1980 facilitates circumventing that in some way. And the deeper you go down that path, the more upset the consumer advocates are going to be, the more potential resistance you're going to get from regulators, and the more resistance you could potentially get from judges. And can you get away with it? Well, I mean, some companies have been getting away with it for a long time, but not because I consented to it, and I'm still trying to get you.
I just want to add one thing. The counterpoint to that is that while the consumer advocates may think, and while the general public may think it's great to put on these limits, I don't think they fully appreciate the full equation. I don't think they fully appreciate the need for affordable access to credit. And affordable access to credit doesn't necessarily mean when a state puts in a usury cap of 16%. What are the people, I mean, interest rates are set based upon the risk that the consumer presents, which means they have to be compensated. And if banks are not allowed to charge above an interest rate, or they're only allowed to charge an interest rate subject to a cap, there's going to be a whole group of people who are going to be excluded from traditional and even fintech-based lending. And that's not right for those people. And that forces those people to go to lenders who are high interest rate, predatory lenders, the kind of people that garner the headlines and that all of the rest of us get thrown into just because we have the ability to lend throughout the country at a stated interest rate, which is not predatory.
To be clear, I have never advocated for a 16% interest rate cap. That's too low. I also don't think that we should have a 2-mile-an-hour speed limit. That's a bad idea in any road. But that being said, a 36% interest rate cap, I have worked on that. And even in a high inflationary environment, 36 provides a pretty good margin. And maybe like New Mexico, the new law, 36% plus a float. That's not crazy either, of some sort.
I really question whether rates over 36% would ever be good for consumers.
That's what I think too, and that's what a supermajority of Americans think. And so, but I mean, where you draw that line and the method that you use to draw that line is obviously going to be very controversial. And I don't know, we're not going to have a successful debate about usury laws today, but the question is, you know, is there anything that drives a lot of what I think that the concerns are with agents? If there's an agency relationship that's being used to circumvent or to go around a law in some way to produce a really high interest rate loan, it's going to get pushed back sooner or later. And I could be, you know, maybe that's misguided, but if you're pushing up into the triple-digit interest rates, people are going to try to find a way to stop it.
Oh, yeah.
Oh, yeah. Last word, but I've got 20 seconds. Do we think we're going to see more enforcement in this space, and is it going to impact the innovation? And I also think another interesting point is just the pressure on the boards of directors. That could be a whole separate session in terms of you look at the corporate governance guidelines of the FDIC and others and some of these enforcement actions, but
For my quick answer, yes.
Yeah.
I definitely think there will be more enforcement here. I'm hopeful that it doesn't affect innovation, and I'm hoping that all of our fintech partners will continue to innovate with guidelines, right? So CMS, another word that's been around forever. If you follow your CMS program, that shouldn't stifle your innovation.
Well, join me in thanking the panel for the time.